So let's answer the question that everybody seems to be asking if you're a passive investor. Are we headed for a massive multifamily real estate correction in 2024? Well, that's what we're going to break down in today's video. We're going to try to make some sense of all the chaos and turmoil that's happening in the multifamily real estate sector and what it boils down to you as a passive investor and what you need to be wary of, or maybe you need to step back from the investing arena altogether as we wait for the dust to settle and see where things land. All right, guys, welcome back to the channel. I'm Dr. Johnny Walker, aka Jonathan Witanachi. I'm a self-made multimillionaire in real estate as well as a veteran endodontist. Investing heavily in real estate over the last 15 years has allowed me to take a giant step back from my clinical practice, spend enormous amounts of time with my friends and family, travel the world 6 to 8 times per year, as well as give me the time to pursue the passions and interests in my life that makes life worth living. One of those passions is to help my fellow dentists achieve true financial freedom, independence from their practice by investing passively in real estate. And that's what this channel is all about. If you haven't done so already and are getting great value from this channel, make sure you smash the subscribe button right now. And please do share this with other members of the community so that you can help get our word out to all those that need it. So will we see a massive multifamily real estate correction in 2024? And the answer is maybe. Since 2008, the feds have gone on a $6 trillion money printing frenzy. $2.2 trillion of that dollars came at the wake of the pandemic in 2020. Now, what you have to realize is that this is 40% of all US dollars ever printed, and it was done in an 18-month period. So we ramped up the money supply. Also during 2020, the Fed slammed interest rates down to 0.05%. So basically 0%. So we got printed a ton of cash, and then proceeded to lower interest rates even more. Then COVID lockdowns created historically significant supply chain crimps and malfunction. Then the money worked its way through the banks into the financial sector. And once that happened, we saw the S&P 500 boom after the post-COVID recovery. We saw multifamily real estate and single-family houses shoot up by 40% between 2020 and 2022. Because the values had gone up so much, especially with multifamily real estate, the ability to get debt financing and that it penciled out to show positive cash flow or positive leverage was not available anymore. We just couldn't get deals to pencil because people were overpaying for things. So what was the solution to that? Well, instead of taking permanent long-term financing, this only way that you could get deals to pencil out was to take riskier bridge loan debt, right? And that became the #1 loan product in 2020, 21, and 2022. And now to quantify how many bridge loans there were 2,500 multifamily real estate transactions between 2020 and 2022. And almost all of them were purchased with 2 to 3 year floating rate debt, right? So the interest rate was not fixed, and it was fixed for 2 to 3 years. And then after that, it would readjust to whatever the prevailing market rate was. Then in 2022, inflation hit 9.1%. It was actually much higher than that, but we have a very doctored inflation index that the government uses. But even with their doctored version, there was still 9.1% interest, and that was the highest rate of inflation in 40 years in this country. Then what happened? Then the Fed reversed course, and they raised interest rates by 110x. The rates went from 0.05% in May of 2022 to 5.5% in December of 2023, which represented the fastest the Feds had ever raised rates in 40 years. So now what does this create? For those of you that picked up the crumbs and followed what I'm talking about, and for those of you that may not have, anyone, and I repeat, anybody, any company, no matter how good, how bad, how much track record, etc., anyone who purchased assets at the peak of the pricing with floating rate debt will get squeezed. Imagine that you took on a loan product and you bought a property in late 2020 with a 3-year fixed debt at 3% interest, and now here we are, 2023, 3 years later, now the interest is 6%. It's over double, your mortgage rate is double, and this puts a tremendous squeeze on cash flow. And if you don't have enough cash flow, it puts you into negative cash flow just because of the debt. So now we already mentioned there's been 2,500 multifamily real estate transactions, mostly with this floating rate debt that's already coming due and is going to be coming due over the next 12 months. In fact, there's an estimated $1.7 trillion of floating rate debt that is set to mature over the next 12 to 18 months. So what does this mean for you as a passive investor? Well, guess what? Situations like this create tremendous uncertainty. They create hesitation, and ultimately it creates scared money. And you know how the saying goes, scared money don't make no money. So now what happens when in these situations, when interest rates are going up, banks get spooked, they stop lending, lenders stop lending, right? When it's now, it becomes this environment where there's all kinds of hesitation, interest rates are so high, multifamily real estate operators are getting squeezed by these rates. And we talked about banks are also scared during these times, and now they've decreased their loan to value, like loan proceeds. So before we were getting 75% loan, 80% loan of purchase price. Now they're giving 50 or 60% of the purchase price. So they're giving less at higher interest rate. What else happened? The buyers also got scared, right? Scared money. Investors also pull back. There's not too many sellers in the market anymore. Buyers, sorry. But what about sellers? Sellers also have gone away. They're like, interest rates are so high. I'm getting offers for my property way less than what I was getting when interest rates were 0%. So now what's happened? These sellers can't psychologically get over the fact that their property's worth a few $1 million less, even though the property's doing great. So what do these sellers do? If they're cash flowing and they're making income from these properties, they're in no rush to sell. They're like, hey, look, I'm just going to wait till interest rates come down. And so sellers also disappear. So if you're in a marketplace where there's less sellers, less buyers, and less lenders, guess what happens? Sales transaction volume drops off a cliff. And that's what we've seen. This means that people at the ends of their business plan, people in these multifamily real estate deals that plan to exit after 5 years with a sale or refinance, can't do it anymore, right? They can't refinance because the loan proceeds are less. Unless they're 95% occupied and just humming along at peak efficiency, it probably doesn't even make sense to refinance. We already know that they can't sell. What this does actually is create massive opportunity. So this is now the answer for the passive investor. Scared money don't make money, but brave money could make a lot of money, especially during downturns. If we are headed for recession, but it's looking exceedingly like we may not be as bad, we might get this soft landing that the Fed has been talking about. That's potential. And they're even talking about making several interest rate cuts and slowly tapering it down to 2024. Number one, the Fed has lied before. Potentially they may not lie. It depends what happens with inflation. Inflation seems to be slowing down, but we don't know that, right? So there's still some uncertainty. Now, if the Feds do start cutting the interest rate back, isn't that going to save these lenders that with these floating rate debt? Well, the answer is still no, because you got to remember the interest rate shot up 110x. So they're going to slowly start bringing it back to normal. If it gets back that low again, it may take years. It may never get back that low. But waiting and hoping that it gets back low while you're bleeding cash is not a great strategy, right? So now there will be distress. There will be the ability to buy properties at very steep discounts, because while nobody voluntarily is selling because they're not getting the prices that they want, those guys aren't selling. But the people that are forced to sell, the people that have this risky floating rate debt that's maturing and now have to sell, otherwise they will be insolvent. There'll be negative cash flow, they'll be bleeding money. So they have to get rid of it, and they have to get rid of it now. So what happens is that if there's not that many buyers, the people that are out there buying, the people with the 2 C's, which is cash and courage, will have the ability to go and buy real estate, multifamily, especially really high quality assets in great markets at steep discounts. To say it in another way, we're going to have the ability to buy quality assets for temporarily undervalued prices. We have the ability to potentially steal deals in primary markets like Dallas and Phoenix, where previously it was impossible because they're ultra competitive markets, and now you have the ability to go and buy these assets for fractions of the price that they were trading for just a year ago. And this isn't in theory. We've actually been, and this is why I'm so excited about my real estate investment company, is we've had the ability to capitalize on this. We've been talking about this situation going to happen over the next 8 months. We've been saying, hey, this is coming, guys. Be ready, be ready. And it's so rewarding and refreshing to know that we were right. And this time we knew it was coming and we were prepared. And so we had the ability to buy a 100-unit multifamily real estate property in Phoenix at a 25% discount. We just closed on another property in Dallas, 288 units of Class B plus prime real estate that we were able to buy at a 30% discount. Ladies and gentlemen, Phoenix and Dallas are probably the number 1 and 2 hottest cities, the best cities with the best underlying demographics for multifamily real estate investment. And we were able to come in and literally steal these properties from the sellers. Sellers are walking away from 100% of their equity, as well as money that they've invested in the property, just to get out. This will continue over the next 12 months. So the answer is you should be very prudent. You have to be very careful with the decisions that you make, because these are uncertain times. So you have to invest with people that know how to navigate uncertain times, people that have done it before. Great operators. And if you can partner with great operators during turmoil times, you will make a fortune during these times. Because we're able to buy these properties at great basis, the returns get ridiculous, right? The cash flows are great. And if the economy does turn around over the next 4 to 5 years, which is the span of our business plan for this property, and interest rates do come down, this goes from being a deal with great solid returns to a home run. We're not depending on that. Our business plan isn't speculating on that, but if we get it, it's cherry on the top. I know some really savvy real estate investors, right? And a lot of times, these savvy real estate investors aren't always investing in the market. Sometimes they're dormant for years. And then a time like this comes, and they see the ability to buy, and then they go on an investing spree. They go on a buying spree. 2008, we had the great financial recession, and we saw the housing market crash. There was a couple that I know, they took $2 million of cash, and they bought 50 70 houses in Phoenix at grossly low prices, right? 30, 40 cents on the dollar. And they made it absolutely, they flipped that 2 million into 15. Previous to that, they hadn't invested anything, but they had the cash, they knew there was opportunity, and they went on a buying. We believe that this is the situation that's happening with multifamily real estate as well. There will be tremendous opportunity. And I'm excited about it. And we are going to be very active over the next 12 months, while a lot of groups and operators are like, hey, look, we're not going to do anything right now. We're going to kind of step back and wait. But that's going to create massive opportunity. Like, listen, if you're a passive investor and you haven't ever invested before, there is no better time in over a decade than right now to get started. We have a real estate investment firm that really focuses on helping dentists navigate this world of private offerings. If you're a dentist, a business owner, and you're looking to get started or just want to learn more about investing passively, or even to learn more about our deals, get on our email list. Right? You can go to our website, www.walkofwealth.com. You can schedule a call with me or one of my teammates. We can personalize strategy for you on how to approach passive investment and what type of products that you could invest in to move you towards your goal. So I do encourage you to go and visit our website and schedule a call. You know, this is a free service that we offer. And again, it's walkofwealth.com. All right, guys, so that's kind of all I have for today. The bottom line is those with cash and courage and just a little bit of prudence will do very well over this time. All right, guys, I'm Dr. Joy Walker. I hope you greatly enjoyed this video. Make sure you smash the like button and click on the next video. We're going to keep the heat coming and keep the bank accounts growing. Let's go. Boom.